Every stock market crash looks like a surprise. The headline says no one could ever have seen it coming. Experts try to explain what went wrong after the fact, and investors are left wondering how everything fell apart so fast. But here is the truth that most people will never hear or admit to. Crashes don't come out of nowhere. They follow the same patterns every single time. Now, market crashes feel unpredictable in the moment, but they're not absolutely random. The timing is random. When people look back after the damage is done, they're going to usually blame one event, a recession, a rate hike, a war, even a tariff announcement. But those are just the triggers, not the cause. There's a great line from John Hussman. He says, in a room filled with gasoline and a fire is blazing in the corner, we don't know which spark will cause the explosion, but guess what? One of the sparks will cause an explosion. And after the fact, we're like, look at that spark right there. It made everything blow up. No, it was just finally the one that people said, wait a second, I got to pay attention here. The real causes are something much quieter. It builds in the background. The best investors like Warren Buffett and Charlie Munger tend to see it coming even when no one else does. Again, they don't see the exact timing of it, but you will notice that their cash positions are building and building, or maybe their buying has become less frequent and their selling is becoming a little bit more often. Everyday investors start believing that the rules have changed, that this time is different without saying that, and that the things that used to matter suddenly do not. And that's what makes crashes so deceptive for the vast majority of people out there. They don't arrive when fear is high. They arrive when fear is its lowest and euphoria is its highest. Across centuries of market history, I don't just mean stock market, I mean any kind of market for selling anything. The same 4 warning signs appear again and again. Sometimes faster, sometimes slower, sometimes all at once. But if they line up together, markets become very fragile, even if prices are still going up. So instead of asking, when will the next crash happen? The better question is, are the conditions that lead to a crash happening right now? How does the future 5-10 years from now look compared to today? So in this video, I'm going to show you the exact 4 things that always happen before a stock market crash. And we're going to use history to show you guys that exact guide. So make sure that you stick around until the end. So guys, the first thing at the backbone of every meteoric rise is that new innovation. This is the part that confuses people because when we talk about bubbles, it's easy to assume that bubbles are built on nonsense, but they're not. The most dangerous bubbles in history are fueled by genuine innovation, new technologies, new systems, or new ways of doing business that actually do change the world. Warren Buffett always says every bubble starts on a very smart premise. Most bubbles, especially stock market driven ones or real estate ones, are based on a very normal and good idea. Innovation creates progress, it creates efficiency and opportunity. It solves real problems. And because it's real, investors start to assume they're missing out if they don't invest in it. That's where the mistakes start. Guys, can you think of a past technological advance in the last 150, 200, 300 years that did not change the world, that made sense it was going to change the world? Of course. And pretty much all of them have been involved in some fashion in a bubble. Investors consistently overestimate how fast innovation will translate to profits, and they're going to underestimate how long adaptation really takes. Early success stories dominate the conversation. We have seen this pattern repeatedly. In the 1800s, for example, railroads were the infrastructure that changed transportation. But massive borrowing took place to try to meet expected demand, and banks financed projects that would never be profitable, leading to the Panic of 1873. And guys, the big key there is banks finance these projects. Bankers are just as dumb as everybody else. They're the people that lead the charge on these. They make the easy money happen out there. The money goes out. Too much money chasing a few deals causes problems. The stock market had to shut down for 10 days, and 6 years of depression followed. Now, in the late 1990s, we're jumping way far ahead, companies were going public with no revenue or profit. They were literally going public on an idea. If .com was in your name, investors bought your shares no matter what. Even though the internet has been one of the greatest inventions in history, the NASDAQ fell almost 80% from peak to bottom. Companies like Cisco, CISCO, not the food person, fell 90%. And many of these hot stocks have never been recovered. In fact, Cisco, after 25 years, has finally surpassed its all-time high from 2000. 25 years later, and you know what the crazy part is? They have several times more revenue and several times more profit than they did back then. And their revenue and profit was just going up like this all along the way. It had never fallen precipitously to a level that justified a 90% fall if it was selling for a reasonable price. Now, I want you to remember, every bubble begins with something real, something that changes the world. But the crash happens because prices get ahead of reality. Now, the second sign of a pending crash, excessive leverage. What is leverage? It's borrowing money. Once innovation takes hold, that next ingredient almost always shows up. Leverage is simply that borrowing money, and in rising markets, it feels harmless. It actually even feels smart. When prices are going up, borrowing looks like a way to just accelerate returns because you don't think you can lose money. That's why leverage is so dangerous. Yes, it accelerates returns, but it also accelerates losses. It magnifies confidence at the exact moment that caution is needed most. As asset prices rise, borrowing gets justified by recent performance. Lenders loosen their standards. Investors convince themselves that future gains will easily cover today's debt. But history shows when prices start to fall, leverage causes permanent losses. I actually have a story for you guys about Berkshire Hathaway that you may not have heard before. In the early days, Warren Charlie had a third partner, a guy named Rick Guerin, something like that. Ricky was actually the one who first found the famous blue chip stamps deal. The three of them searched for investments together and all owned shares of Berkshire. But after the 1970s, no one really ever heard of Rick again. Warren and Charlie did not use leverage while investing in the stock market, but Rick always did because he wanted to get rich much faster. Then he got margin called when the market crashed. Buffett bought Rick's stock from him for $40 per share. Today, those same shares are worth over $750,000. Now, I take leverage on things, but I don't borrow against risky, volatile assets to buy more risky, volatile assets. So when you're buying stock to buy more stock, now you have twice the amount of money that's absolutely correlated with itself. I take on 25% debt, and I will use it to buy real estate, a very illiquid asset. But that liquid asset has less likelihood of being called. So I'm not against debt. I'm against irrational and exuberant debt. Now, a bank will let you borrow 60 or 70% of your stocks. But if you're taking $1 million account, borrowing $700,000 on it to buy more stock, and the stock prices go down 10%, 15%, you're going to have a problem. And there's nothing worse than being forced to sell when you don't want to sell. So let's get back to it. You already heard me mention the 1873 railroad panic. It only ever became a panic because the expansion was financed so heavily using debt. What about 1929? We've all heard of the Great Depression. But at the time, did you know that stocks were commonly purchased with as little as 10% down? That is 10x leverage. What that means, guys, is if you wanted to buy $1 million of stock, you just had to put $100,000 down. Before, I was saying use $1 million to buy an extra $700,000. You could have used that $1 million to buy $10 million of stock. So when prices dipped, margin calls meant that investors had to sell. When they had to sell, what happened to prices? They went further. As they went further down, what else had to happen? More selling. The Dow fell 86%. It took 25 years to recover. Guys, sadly, a lot of people took their lives from this because they were absolutely obliterated. They lost people's money, and that was tough. More recently, 2008, the great financial crisis, banks themselves were levered 30 to 40 times their capital. If you ever watched The Big Short with Michael Burry, you know that CDOs and mortgages being sliced, rated AAA, and then resold. Lehman Brothers collapsed. The S&P fell over 50%. So remember, leverage alone doesn't necessarily cause crashes, but it can be what makes them uncontrollable. The third common trait of all stock market crashes is confident speculation. Think crypto. By the time speculation takes over, prices have already been rising for a while. Confidence hardens into something more dangerous, certainty. Investors stop asking whether something is a good investment and start asking why anyone wouldn't own it. Major FOMO kicks in. Skeptics aren't debated anymore. They are mocked. Does that sound familiar? Valuation concerns are dismissed as outdated. Someone like Warren Buffett becomes a dinosaur. Just the other day, a friend of mine texted me about a great business owner that he knew who Warren Buffett and Charlie Munger tried to buy their company, and he kept saying no. And I looked at him, and he's one of the guys who thinks I'm a dinosaur with my thinking and investing. And I said, aren't Warren Buffett and Charlie Munger dinosaurs? Why are you bragging that they wanted to buy your buddy's business? And he laughed at it, but that was my point. Like, we all criticize them because we don't want to believe what they're saying is true. And price increases in and of themselves become the justification for more buying. If something keeps going up, it has to be correct. History is filled with these examples time and time again. Let's go all the way back to where the first bubble recorded ever started. The Netherlands in the 1630s. That's right. The Netherlands created the first stock market. They even invented futures markets. This all led to what's been named the tulip bubble. Tulips, the flower, guys, became the status symbol of wealth. People were paying 5 to 10 years' salary for the right to buy them a year later. It sounds ridiculous, but it's true. Eventually, prices crashed 99% over a week. And guys, that was before the internet. That was before any sort of communication. If you wanted to tell your family in another town one over, it probably took 3 weeks for them to get the message and back to you. Imagine what would happen today. Now, another example from way back in the day, the South Sea bubble. Guys, even Isaac Newton, the smartest man arguably ever alive, got caught up in that speculation. Basically, the South Sea Company promised riches from trade with South America. The stock went up 8x. Then people realized that Spain controlled the ports and wouldn't allow trade. It collapsed 85%. After initially selling for a profit, Newton bought back in near the top because he couldn't stand watching others get rich. That is the definition of FOMO. But in more recently, 2021, we saw meme stocks and crypto surge. And I don't know if you guys remember a thing called NFTs. And we criticize NFTs, even though I said NFTs made way more sense to me than crypto. Companies like GameStop, Tattooed Chef, and Workhorse rose exponentially. Nikola, exponentially. I warned people at the time. I went against the grain. And guys, the amount of criticism that we heard. Oh, this guy's an idiot. Look at these stocks going up. Guys, GameStop, Tattooed Chef, and Workhorse. Nikola. Those are 4 companies. One still exists today. 3 of them, those 3, they're all gone. You might sit there and say, well, I'm cherry picking. I'm not. I'm cherry picking the one that actually made it. And guess what? GameStop is still going through issues. They're trying to become a crypto company right now. Guys, this is why I teach on YouTube. I'm here because I made these mistakes and I was sick of having people fall for the same traps over and over again. Now, I'm not saying that I'm some guru, but do I have a different way of thinking about the world? I think I do. I'm sitting there saying when I see everybody saying something, it tends to make me cause a little bit of pause there. Am I early? Usually. Most of us are. But this is the thing you have to think about. You have to sit there and say, what is your goal in life? Is it to sleep well at night? If it is, you want to understand what you're buying. If you understand what you're buying, you're going to deal with the drops in price. Now, this is the warning sign that most people miss. Confidence feels great. Speculation feels completely justified. Guys, I don't think I'm a speculator, but every time I invest in a real estate deal, I wonder, am I just chasing it because of our recent success in real estate? But the more confident the speculation becomes, the less margin for error remains. At that point, the market doesn't need bad news to fall apart. It just needs results to be a little bit below expectations. When everything is positioned for perfection, even small misses can trigger large reactions. Now, the fourth and final theme between all market crashes: overvaluation. This is where everything finally breaks. Not because of fear, not because of bad news, because the math just stops mathing. Overvaluation doesn't tell you when a crash will happen. Remember that old John Maynard Keynes quote, markets stay irrational longer than you can stay solvent. What overvaluation does tell you, however, is how fragile the system has become. When prices get too far ahead of fundamentals, future growth is already built into current prices. And once that happens, there's very little room for disappointment. So you might be asking yourself, how can someone see that the market is overvalued? Well, to help answer that question, let's talk about a few different time periods I've already mentioned, 1929, 1999, even go back to the late 60s. But the Great Depression and dot-com bubble were instrumental in great lessons. What do these periods have in common? Well, first off, we know that major crashes followed, and a decade or more of no returns. But also, the 2 most reliable valuation metrics throughout history were at their highest levels at that point. Let's start with this. The 10-year PE ratio, the Shiller PE, measures how expensive the stock market is by comparing today's price to the last 10 years of inflation-adjusted earnings. It takes those last 10 years of earnings, brings it to today and today's prices, and takes the price and divides it by that. The average PE over more than a century is 17x. The absolute highest ever been in history was late 1999 at 44 times earnings. In 1929, right before the Great Depression, it peaked at 31. Guys, today it's at 40.5. But let's not stop at the Shiller PE. What about the Buffett indicator? Warren Buffett, yes, that dinosaur's favorite metric for deciding whether or not the market's overpriced. It takes the total value of the stock market and divides it into the entire US GDP, and it makes sense. As the GDP grows, the companies within that GDP should get bigger. Before the past 2 years, it reached its highest point of 150% back in 1999. Markets don't just crash because of bad news. They crash because prices leave no room for any negativity. Today, we're at 220%. 50% higher than we were in 1999, 130% higher than the average over history. Hope is not a plan. I used to buy stocks hoping that they would go up, but hope doesn't protect you when the market turns. Hope doesn't help you sleep better at night. Hope doesn't decrease your fear. I had to learn how to build a real strategy, one that makes sure that I personally never go to zero. Now, every investment I make is based on numbers, not hype. This is why I built Everything Money. It was built for me. I wanted the tools that gave me clarity, took the fear out of investing, and helped me make better decisions that helped me sleep better. People saw me using them on YouTube and said, Paul, can you give us that software? And I said, well, I can't because it's mine right now, but I can create it. And so I did, and a real community was born. Real people sharing ideas, live chats, live streams, and tools that help beat 99% of investors. I still use these tools like the Stock Analyzer every single day. Stop guessing, start learning. Click the link below, try our trial, $7 for 7 days, and see how confidence will replace your fear. So guys, let's bring these 4 themes together. First comes innovation, then cheap money and leverage accelerate it, confidence turns into speculation, and eventually valuation becomes detached completely from reality. That's the sequence. For anyone who follows famous investor Howard Marks, who's a brilliant man, he wrote the book Mastering the Market Cycle. And he's also frequently making memos on the state of the market, which I highly encourage everybody to read. He discusses heavily that a bubble is more than just valuation. It's speculation, it's an irrational exuberance. Guys, this is what I personally missed in my last 4 years. My last 4 years have been me going, valuation has to matter at some point, not paying attention to the fact that people were not completely delusional quite yet. So let's talk about that right now. Let's talk about this market. As we start off 2026, we're coming off a 3-year run of excellent returns. But are there destined to be more good years in the future, or could we see a major correction? To answer that, let's review our 4 major signals. First, innovation. 2 words for you, artificial intelligence. AI is changing the world. Enthusiasm remains the core driver of markets. Major indices hit record highs largely on the back of AI-related gains this past year. I have no doubt that AI will change the world. It already is, but so did railroads. So did cars, so did computers, so did airplanes, so did the internet, so did every other technology that's ever existed. So what about debt? Guys, I actually don't see a ton of debt. Yes, is there a lot of margin debt out there? Yes, but it's not as high relative to values as people would think. But the question is, how overvalued are we? So this one's actually the hardest one for me because I don't hear stories of people taking on massive debt to go buy stocks or things like that. Am I seeing other people's debts go up? Yeah, debts are going up in general. But I'm not fully convinced that this one is bad or will be bad. Next up is speculation. Guys, in late 2025, news broke that OpenAI signed a massive cloud computing deal with Oracle, a company that's been around for decades. It was reported at around $300 billion over the next 5 years to provide capacity for AI workloads. Ready for this? Oracle's shares soared 40% on the news, but have since pulled back completely and is now lower than when the deal was announced. What was the reason? Investors realized that hundreds of billions of dollars in debt were needed to finance the project. So it's a combination of speculation and debt in that regard. But the final piece of the puzzle is valuation. And I know when I was discussing it earlier, you probably wondered, well, where do we stand? As I was discussing it, well, I told you, the 10-year PE is at 40.5, the second highest ever, and the Buffett indicator is over 230%, which is 130% over its historical average. The level of valuation we see right now is so far above any other time in history when looking at both of them together. Now, guys, I made it very clear at the beginning. This is not about predicting when the market will crash. It will crash at some point. We will have a bear market at some point. This is about making sure you understand where we stand today based on these 4 reliable themes. And to remind you that it's unlikely that the next 10 years look as good as the last 10 years. But I want to make sure you know how to protect yourself when the crash does come. When I say protect yourself, I don't mean not losing money. I mean being emotionally sound and stable and saying, I'm okay with this. This is what we planned for, and it's an opportunity. So the first piece of preparation for a stock market crash is making sure you have a sound process in place. For most people, I will recommend the exact same thing Buffett does and every major value investor. Buy low-cost ETFs consistently month in, month out. That means you're going to buy at the highs and you're going to buy at the lows. But overall, you're going to own at the right price. And you can expect to make average market returns over decades. Now, for a few select investors, you can do better. You can invest in individual stocks once you've taken the time to learn what investing is really all about. This is exactly what our investing community members do. But remember, the vast majority of our investing community has ETFs, even though they buy individual stocks. I dollar cost average every single month. Other piece of important advice I have for you guys is don't end up with 90% of your net worth invested in one hot AI stock. Someone who owned the S&P at peak levels during any part of the crash would have been fine. But if you owned the South Sea Company in 1720, or Pets.com in 99, or Lehman in 2009, you would have lost everything. You want to make sure that your investments don't keep you up at night. I sleep so well at night, even when stocks I own are down 40 or 50%, because I have a portfolio of 28 companies that I think are great. I have over 1,000 units that I own and manage. I say upstairs, not literally upstairs, but around the country that we manage upstairs. I have short-term treasuries. I have individual houses that I rent out. I have a diversified group of businesses. 70% of my net worth is locked up in real estate and private businesses. 30% is in cash and the stock market. That's what we try to preach here at Everything Money. It's not just about finding the next big winner. It's about developing your process, understanding your financial situation, and applying your knowledge to make sound investments. So as we wrap up this video, I want you to remember, every crash looks different on the surface, but underneath, it's always almost the same four forces working together: innovation, excessive leverage, speculation, and valuation, prices that move too far ahead of reality. Hopefully these signals will help guide you through the future market cycles and give you a little more clarity on where we stand right now, because you don't need to predict the exact moment the cycle turns. You just need to recognize that risk is building and have a plan before your emotions take over. That is how disciplined investors survive market downturns. And it's how the best investors put themselves in position to benefit. Now, guys, we recently released a video explaining the exact 3 ETFs that I would choose to dollar cost average into today if I was starting over. In fact, these 3 ETFs, I'm already buying one of them, and I plan on buying the other 2 at some point in the near future. But most importantly, I would buy them during a crash and after a crash consistently. So if you want to see how this strategy allows you to retire a multimillionaire, check the video right here. Thank you for your time.